Friends, I have a question for you. If I told you there is an asset that has increased sevenfold in the past 20 years and 50-fold in the past 50 years, and right now the smartest central banks in the world are buying it in a frenzy, what would you guess it is? It is not Bitcoin, and it is not tech stocks. It is gold. What is even more shocking is a piece of data that 99% of investors have ignored. In just 1 year, global central banks purchased 1,082 tons of gold. What does that concept mean? That is equivalent to the total annual gold production of 40 countries combined. This is absolutely not a coincidence. I am willing to bet that hidden behind this is an ultimate secret that can completely change your financial destiny. Today, we are going to strip away the noise and look at the raw mechanics of the world economy in 2026. You might think the people buying gold are old-fashioned, but you would be wrong. The entities buying gold are the sharpest capital on this planet. They hold the keys to an ultimate law that ordinary people rarely touch. I call this the gold cycle code. This code not only explains the booms and busts of the past century, but also predicts the future flow of global wealth. The real driving force behind gold prices is not just inflation or risk aversion, but a complex system of nested cycles. Most investors miss this. Economic cycles are not singular, they are layered. The outermost layer is the 60-year Kondratiev wave, which is the heartbeat of technological revolution. In the middle is the 8 to 10-year equipment investment cycle, and at the core is the 3 to 3.5-year inventory cycle. But above all these sits the most terrifying existence of all, the 100-year cycle of hegemonic politics. This hegemonic cycle controls the ultimate rotation from free trade to protectionism. When a global hegemon is in its rising phase, it establishes a global financial system centered on its own currency. In this process, gold is the enemy because it represents independent value storage that threatens the credit of the hegemon's currency. Look at the 1980s. To establish the absolute dominance of the dollar, every means was used to suppress gold. It fell from $850 in 1980 to under $300 in the late 90s. Many thought gold was dead. Even the British government believed it and sold off their gold reserves at the bottom between 1999 and 2002. In hindsight, that was the greatest strategic bottom-fishing opportunity in history. Now, the situation has reversed. The hegemonic cycle is entering a decline phase. We see trade wars, technological decoupling, and the weaponization of currency. History tells us that when hegemony begins to fade, gold goes through 3 stages. First, visionary capital lays out its positions. Second, the hegemon fights back, smashing the market to prove it is still the boss. Third, after the counterattack fails, there is a vengeful rebound. We are currently navigating the transition between these volatile stages. But there is a deeper layer. We are at a critical juncture of the Kondratiev wave, the depression phase. This phase is characterized by a fierce game between human nature and reality. Initially, everyone accepts that the economy is struggling, but governments cannot sit still. They intervene frantically, engage in trade protectionism, and dismantle the globalized system. In this phase, paper currency credit begins to crumble, and hard assets take the spotlight. This brings us to the current situation with the U.S. debt and the desperate measures being taken to sustain it. We are witnessing a gamble of historic proportions. The U.S. government is burning through $23 billion a day just to pay interest. The debt hole is $38 trillion deep and growing. To understand the scale, if you spent $1 million every day since the birth of Jesus, you still would not have spent $38 trillion. The interest payments alone in 2025 reached $1.7 trillion. For every $4 of revenue collected, $1 goes to pay interest. This exceeds the defense budget. Why hasn't this system collapsed? Because the dollar is the global reserve currency. But that privilege is eroding at a terrifying speed. The share of the dollar in global foreign exchange reserves has dropped significantly. Central banks are diversifying into euros and gold. The largest creditors are selling. In 2025 alone, major foreign holders dumped hundreds of billions in U.S. debt. When yields spike, the cost of borrowing for the U.S. economy skyrockets. If the 10-year Treasury yield hits 6%, the annual interest payments would exceed $2 trillion. No budget can sustain that. So, what is the solution? Wall Street and Washington have concocted a new strategy involving stablecoins. This is what they call the Genius Act. The idea is simple. Stablecoins are digital dollars. To issue a stablecoin like USDT or USDC, the issuer must hold equivalent reserves, primarily in US Treasuries. This creates artificial demand for US debt. If the market cap of stablecoins reaches $2 trillion, that is, nearly $2 trillion of US debt that is bought and held. It acts as a sponge to absorb the debt that foreign central banks are selling. It is a brilliant financial engineering move to keep the game going. However, it comes with massive risks. If the reserves aren't there, or if there is a run on these digital banks, the sell-off in treasuries would be instantaneous and catastrophic. It is a liquidity trap waiting to happen. While this financial maneuvering happens in the West, we must look at the structural changes occurring in the East and the global South. A major shift has occurred regarding the World Trade Organization. For decades, the developing country status was a point of contention. Recently, there has been a strategic pivot. The logic is no longer about fighting for a label, but about securing real supply chains and markets. The global economy is splitting into two distinct operating systems. One is a closed loop of high-tech protectionism, and the other is an open platform of inclusive trade focused on the global South. By voluntarily moving away from preferential treatment in some areas, the strategy is to solidify alliances with emerging markets. Think about it. The average GDP per capita in the leading developing nation is still far below the threshold of developed nations. The move to align strictly with the global South is not a retreat, it is a consolidation of the consumer base. Who will buy the goods in the future? The developed world consumption is saturated. The growth is in Africa, Latin America, and Southeast Asia. By building infrastructure, ports, railways, and digital networks in these regions, new markets are created. It is about cultivating consumers, not just exploiting producers. This is the difference between aid that extracts resources and investment that builds capacity. When you build a road and a port, the local economy grows, people have money, and they buy your products. It is a long-term play for the next 50 years of trade dominance. Now, let's talk about the disconnect between financial wealth and industrial reality. There is a fascinating contrast in the corporate world. On one side, you have companies like Tesla, where shareholder votes approve compensation packages worth tens of billions of dollars for a single individual. This reflects a financialized economy where stock price and narrative drive value. On the other side, you have the rise of industrial giants in the East, like the builders of the Fujian aircraft carrier. The difference in philosophy is stark. One system rewards financial leverage and market capitalization. The other rewards industrial output and tangible technological breakthroughs. Take the electromagnetic catapult technology on the Fujian ship. This is not just a military asset, it represents a mastery of high-end manufacturing. Steam catapults are like a pressure cooker. They take time to recharge and are harsh on the airframe. Electromagnetic systems are like maglev trains, efficient, adjustable, and capable of launching 30% more sorties. The fact that this technology was deployed so rapidly indicates that the industrial gap has closed significantly. The catch-up speed in basic research and high-end manufacturing is the real story. While the West focuses on software and financial engineering, the East has focused on the hard tech of materials, energy, and propulsion. However, we must be objective. The gap in original innovation still exists. In terms of Nobel Prizes and fundamental theorems, the West still leads. But in the ability to apply technology and scale it up, the dynamic has shifted. It is like running a marathon. The chaser was sprinting to catch up, closing the gap from 20% to 70%. Now, the pace has slowed because the easy gains are gone. The last 30% is the hardest. This is the hardcore phase of the competition. Speaking of competition, we cannot ignore the geopolitical maneuvering involving Europe. There is a quiet but brutal game being played. The data shows a strange phenomenon. Interest rates were cut, but capital did not flow as expected. Why? Because the interest rate spread between the US and other major economies actually widened in real terms due to exchange rate fluctuations. The result is that capital is being sucked out of Europe and Japan towards the US. Look at the recent exchange rates. The euro and yen have faced immense pressure. This is not an accident. It is a feature of the current global financial architecture. By maintaining high interest rates longer than its allies, the US attracts global liquidity. Europe becomes the primary victim. Its manufacturing is hit by high energy costs and a lack of export competitiveness, while its capital flees to Wall Street. It is a ruthless mechanism where allies act as a financial buffer. The sacrifice of Europe is a necessary condition for a soft landing of the U.S. economy. The trade data confirms this. While tensions rise across the Pacific, the real economic damage is appearing across the Atlantic. Now, let's shift gears to a very different topic: why some resource-rich countries fail to develop economically. Let's look at Russia. It is a case study in how geography and climate dictate destiny. You might ask, why does a country with so much land and resources struggle to diversify its economy? The answer lies in the cost of distance. Moscow is 1,200 kilometers from the nearest warm water port. Compare that to London, New York, or Shanghai, which are right on the water. In the globalized economy, maritime transport is king. If you have to move goods 1,000 kilometers by land before they even reach a ship, your profit margin is gone. Then there is the cold. Building a factory in a tropical delta requires a sheet metal roof. Building one in Siberia requires thick walls, heavy insulation, and expensive heating 24/7. The capital expenditure is double or triple. Plus, the population density is too low to support robust service industries. This creates a vicious cycle. The economy cannot compete in manufacturing, so it relies on resource extraction. To protect those resources and force access to markets, the state becomes militarized. The economy serves the military, not the other way around. This structural trap explains the inevitability of conflict more than any ideology. It is about the desperate need for secure, warm water access and the economic inability to compete in a free market. Finally, we need to talk about the consumption shift happening right now. If you are in your 30s or 40s, you need to listen to this. The data is overturning everything we thought we knew. We used to think the 30s were the prime spending years, not anymore. The consumption curve is changing. The 30s are now the years of maximum pressure: marriage, housing, children. The average age of marriage has pushed past 30. The cost of entry into the housing market sucks up liquidity. The real spending power is shifting to the 40-plus demographic. This generation, born in the 80s and 90s, caught the tail end of the high-growth era. They have assets. The younger generation, however, is facing a different reality. They are switching from asset-based consumption, borrowing against rising home values, to cash flow consumption, spending only what they earn. This is a massive structural change. When housing prices stop rising, you don't feel rich, so you don't spend. We are seeing three major switches happen simultaneously. First, the income growth switch. High-growth industries like the internet and finance are slowing down. Second, the asset switch. Real estate is no longer a guaranteed piggy bank. Third, the market switch. Companies are fighting price wars because the pie isn't growing. Look at the car market. The phone market prices are dropping, but people are still hesitant. This is the paradox of thrift in action. But it is not all doom and gloom. It is a restructuring. The consumption market is splitting. For the young, it is about cost performance and emotional value. Camping, pets, niche hobbies. For the middle-aged, it is about efficiency and health. Smart home devices, service robots, healthcare. The economy is moving from a build more stuff model to a service and experience model. Let's return to the big picture. The 155 plan, mentioned in strategic circles, refers to the preparation for a potential hard decoupling. It is like calculating the cost of a divorce. You don't want it to happen, but you prepay the legal fees just in case. The reliance on the U.S. market is being systematically reduced. The export dependence on the U.S. has dropped from 20% to under 10%, yet total exports are up. How? By pivoting to the global south. This is the dual circulation strategy in practice. You import soybeans from Brazil instead of the U.S. You build power grids in South America. You sell EVs to Southeast Asia. It is a complete rewiring of the global trade map. The U.S. strategy of modern monetary theory, printing money to consume, and the Eastern strategy of production primacy, building things to earn money, are decoupling. The U.S. prints money to buy goods. The East produces goods to buy resources and assets. This cycle is breaking because the East is no longer willing to recycle those dollars back into low-yield treasury bonds. They are buying gold, mines, and ports instead. And what about the tech war? Look at the TikTok scenario. It was never just about a social media app. It was about who controls the algorithm and the data. The solution that emerged, a localized data structure with third-party oversight, is a template for the future. It allows the business to operate while keeping the core code proprietary. It is a pragmatic, business-first solution to a political problem. It shows that despite the rhetoric, capital wants to flow. The U.S. investors and the parent company want their returns. The advertisers want the reach. Money often finds a way around the political blockade. So, where does this leave us in 2026? We are in a world of fragmentation. The era of a single, unified global market is over. We have the dollar block and the gold commodity block. We have the financialized economy and the industrial economy. We have the demographic that holds assets and the demographic that relies on cash flow. The key takeaway is this: do not bet on a return to the normal of the 2010s. That world is gone. The new normal is volatility, higher transaction costs, and a premium on hard assets. Whether it is gold, technological capacity, or control over supply chains, the value has shifted from financial promises to tangible realities. The divorce fee for the global economy is being paid right now. It appears as inflation, as tariff barriers, and as social friction. But for those who understand the cycle, who understand why central banks are buying gold, why trade routes are shifting to the south, and why consumption patterns are aging, there is opportunity. The world isn't ending, it is just rebooting with a different operating system. You need to update your understanding, or you will be left running obsolete software in a new hardware reality. Friends, the analysis today is cold and hard because the reality is cold and hard. We are witnessing the rewriting of the rules that governed the world for 80 years. Keep your eyes on the flows of gold, the shifts in debt, and the map of infrastructure. That is where the truth lies, not in the speeches of politicians. Stay sharp, stay informed. We will continue to track these massive shifts in the next broadcast. Thank you for listening.